Welcome back, viewers. You're watching the Savera and I'm Shefali. Is the US economy headed for a recession? A recession happens when an economy's GDP contracts for 2 consecutive quarters. A recent SBI research report says that the long-term US GDP growth shows a declining trend. Concerns have risen about the economic outlook of the US post-Trump's tariff measures and cutting off spending and jobs. Economists view Trump's trade conflict as a potential threat to the American economy, with possible consequences of increased consumer costs, reduced economic growth, and diminished employment. The report also cautions that the zero-tree mission of departments like DOG can undergo a lot of groundwork done in the previous decades, putting downwards pressure on the beleaguered economy. DOG, or the Department of Government Efficiency, is an initiative of the US President Donald Trump and is headed by Tesla CEO and Trump advisor Elon Musk. The economic unrecently looms large, particularly noteworthy as it follows a period when the US economy demonstrated remarkable strength whilst managing the COVID pandemic crisis. So is the US economy headed for a recession? We'll take a look at some important data pointers in the SBI report or on the expected trends in the US economy based on the long-term history. Now, what US economic data is pointing to? Number 1, GDP growth trajectory. Analysis of US GDP growth reveals a downward trajectory, particularly evident since 2000, says the SBI report. America's economic indicators suggest a reduction in potential GDP alongside weakening demand and investment patterns. The US economy has weakened over the last year, with GDP growth declining from 3.2% in Q4 2023 to 2.5% in Q4 2024. Number 2, debt. Rising national debt levels have become increasingly significant, resulting in diminished private sector participation. Current trade policies involving tariffs are expected to create immediate challenges without substantially improvement in GDP performance. Number 3, reduced exports consumption. Post-COVID, US economic growth appears exceptional, attributed to extensive policy measures. Extended analysis suggests a probable decline in US economic growth accompanied by reduced exports and consumptions. Number 4, savings to GDP ratio. Total factor productivity growth is diminishing while value addition shows negative progression. Elevated wage levels might defer future investments. The saving to GDP ratio has reached its lowest point since 2011. Marking the second lowest figure since 1951. January witnessed the first decline in consumer spending in nearly 24 months, whilst the good trade deficit reached unprecedented levels due to business accelerating imports to avoid tariff implications, suggesting possible economic contraction this quarter. Consumer expenditure trends are expected to weaken in correlation with the projected overall GDP slowdown. Number 5, stock market mayhem. The S&P 500 has given up its post-November election gains, with March 2025 projected to record the poorest monthly performance since the COVID-19 period. US markets, including the S&P, with a market capitalizing of approximately $52.9 trillion, appears to have reached their limits after delivering exceptional returns. Investors are reassessing earnings forecast amidst persistent volatility. The prominent Magnificent 7 stocks display vulnerability following the DeepSeek event, with traditionally stable companies like Apple facing scrutiny of their safe haven status, says the SBI report. Investment flows are shifting towards more affordable market as investors seek enhanced returns, evidenced by increased activity in mainland China and Hong Kong market. Analysts anticipate possible corrections in overvalued markets. The ongoing series of reciprocal tariffs create conditions for increased market instability and forthcoming periods. US economy What's the long-term outlook? The SBI report says that positive structural adjustments could potentially elevate GDP trends. Despite modest productivity improvements, increased national savings could enhance potential GDP. Private sector re-engagement combined with technology advancements could boost growth prospects. The initial adaptation period may present challenges. The SBI reports notes the following. The US economy long-term trend in GDP indicate decline in potential GDP, demand and investment. The US indebtedness has sharply increased over the years, crowding out the private sector. Although high debt has not reflected in US dollar, which shows cyclical trends, its strength has over the years has declined. The current tariff policy will have short-term plan and US GDP will not see acceleration in material way. The economic rationale of US dog is evident from long-term trends. If the structural adjustment gains traction, then potential GDP trends can see an upward shift. The larger national savings that come from an exercise despite nominal improvement in productivity can still push the potential GDP up. The crowding in of the private sector thus follows along with technical progress can add significantly to growth projects. However, this adjustment will have short-term costs. That's all for now. For more update, download the Savera app. You can also follow us on Facebook, Instagram, Twitter and YouTube.